Where is the cash flow on the tax return or the financial statement? Hi, I'm Josh Horn with Horn Valuation. I help attorneys and business owners with business valuation. Where is the cash flow? Where do you look for it? Why does it matter? Well, it matters because if you are a litigant and you want to get paid, that's what you are going to get paid with. If you are a divorcing spouse, if you are a disgruntled shareholder, if you are buying a business, selling a business, that's how it's going to happen. That's how it's going to be paid. You are going to be paid back with cash flow. It is the most important number in a lot of cases when you're talking about the value of a business. So where is it? Where do you look? Where do you find it? That's what we're going to talk about today. So we're looking at a fictional tax return for ABC Company. ABC Company is an S corporation filing form 1120S. A very common tax return. S corporations and partnerships are also known as pass-through entities. So I'm going to throw that term around a little bit. Why does this matter? A lot of businesses are S corporations or partnerships, and this may be all you get. This may be all you see in a situation where you need to determine the cash flow of the business for your client and possibly determine the value of that business as well. So ABC Company has $141,000 ordinary business income on page 1. This is an oversimplified example. We're going to take this slow and easy. Just remember the 141. I'm just going to thumb through this return really quick, and we'll see page 3. I skip past page 2 because there's not much there. And page 4 has a balance sheet. Note the $141,000 there, and note the $141,000 here. Now, oftentimes, the 141 is not going to be the same throughout the tax return. Again, I made this very simple. Many times, when I'm doing an analysis, I'm going to start with this page 5, net income per books. That number may differ wildly from the one on the front page. So that's something to keep in mind, is that the income per the books of the business may be different than the ordinary taxable income of the business. So that's another thing to keep in mind. But understand that this page 5, the net income per books, is often where I start when I'm doing an analysis of a company. All right? So let's take this to the next step. So let's take our tax return analysis to the next level. Let's estimate the cash flows of this business. We're going to start with the $141,000 that we looked at on the tax return. Recall book income. We're going to estimate some reductions for state and federal income taxes, as well as a reduction for working capital increases needed to fund the growth of the business. After that, we're going to estimate a future ongoing cash flow of this business of $95,000. So let's ask the question again. Where is this cash flow on the document that we just looked at? Here's the punchline. Nowhere. It's not there, and it likely will never be there. So the most important number, and a lot of times in your case, is not going to be on the documents that are in front of you. At a minimum, you're going to have to adjust for federal income taxes when you have a pass-through entity, possibly working capital requirements. It gets even more complicated. What about personal expenses? What about inventory? What about salaries that are above or below fair market value? I didn't even get into that. So the thing that you need to understand, the one thing I want you to take away from this today, is that cash flow is unlikely to ever be on the documents that land on your desk, if only by dumb luck. All right, this is very important. Now keep in mind, again, I oversimplified this. A couple of assumptions I made here were that the capital expenditures for big fixed asset items are going to be the same as the depreciation, and that there were no long-term debt payments for this business. That may not be the case for you, so that's a couple of more questions to ask. Again, detailed analysis by somebody like me that understands these pieces is required to do this right. I also estimated the value of this business Please don't use this number. It is a rough approximation of what a business generating $95,000 in ongoing cash flows might be worth, roughly $594,000. And note how much this number can move around if you miss on the cash flow. Let's just take this number. Let's make it $200,000. Wow. $1.2 million business. Let's make it $50,000, $313,000 business. So as you can see, by moving that cash flow number up or down, or how bad you miss on it, it can have a huge impact on the value of the business and what your client ultimately gets, or you as a buyer or a seller of a business, or someone that is involved in a litigation environment. Very important to understand what the cash flow is and how it impacts value. So why does this happen? It's not a conspiracy, I promise, although the accounting gods made sure that this was going to be the case. In simple terms, the accounting rules, if you will, ensure that profit and cash flow are almost never going to be the same. There are some rare instances where they might be the same, but very rarely, because cash flow is created by the interaction between the balance sheet and the income statement. So there are all kinds of factors that come into play on the balance sheet that don't hit the profit. For example, if you have to pay for debt service, so you have to pay some debt, buy a piece of equipment, maybe you're buying a business. What about the capital expenditures of the business? Generally, they run through the balance sheet, not the profit and loss or the income statement. What about things that can impact the tax return that you need to know about that maybe shouldn't be on the tax return? What about those personal expenses that shouldn't be there? What about things that are allowable on the tax return that aren't allowable in the particular jurisdiction that you are involved in? Certain kinds of aggressive depreciation that is perfectly legal on the tax side may not be acceptable in the courtroom. Those kind of things can impact this. And remember, pass-through entities don't pay federal income taxes. However, the general consensus is you need to impute the income taxes because they will be paid at the personal level. So they will be paid, they just won't be paid on the tax return you are looking at. And who cares about this? Well, just about anybody with an involvement in a business, even along the periphery. So that includes a divorce litigation attorney, a buyer or seller of a business, a divorcing spouse, a banker, a disgruntled shareholder. Any of these folks out there, if you're watching this, you need to be very, very concerned about this. You need to be understanding what cash flow is, what it looks like on a go-forward basis, how you estimate it, and if your expert knows how to get it. This is Josh Horn of Horn Valuation. I greatly appreciate your time. Have a good day. Bye.